If you follow the financial world at all, you're constantly hearing these two terms, bull and bear. But they're way more than just market jargon. They really represent the two fundamental seasons of finance. And knowing which season you're in, well, that's pretty much everything for an investor. So are these forces your friend or your foe? Honestly, the answer to that depends entirely on whether you actually understand the game they're playing. So in this explainer, we're going to break down exactly what makes these beasts tick. All right, let's kick things off with the good times. We're going to talk about what happens when the market just decides to charge full steam ahead. This is all about riding the bull. So what is a bull market really? It's not just a good week or two for stocks. No, we're talking about a sustained period of rising prices. And yeah, it's typically fueled by strong economic growth. But the real rocket fuel here? That's investor confidence. That collective belief that the good times are just going to keep on rolling. And the signs, they're everywhere. Of course, you've got rising stock prices, but you'll also see strong economic data coming out and a surge of money or liquidity just flooding into the markets. But here's the big tell. You'll see people's appetite for risk just skyrocket. That's when you start hearing your neighbor bragging about their stock picks at a barbecue. That right there, that's a classic sign of a mature bull market. But a bull market isn't just about the numbers on a screen. It's a feeling. It's a whole emotional state. It's driven by this powerful cocktail of greed, optimism, and at its absolute peak, just pure euphoria. It's that feeling that the party is never, ever going to end. But of course, what goes up must eventually come down. And when that party finally does end, the market goes into a kind of hibernation. And that brings us to the other side of the coin, surviving the bear. A bear market, well, it's a harsh reality check. And while any downturn can feel pretty bad, there's an official line in the sand. We're talking about a drop of 20% or more from the recent highs. Once we cross that threshold, we are officially in bear territory. So what causes this? Well, it's usually a nasty mix of factors. The economy might be hitting the brakes, central banks could be jacking up interest rates to fight inflation, and all that easy money that was sloshing around, it starts to dry up. That combination creates this powerful negative wave of investor sentiment. And just like that, the entire psychology of the market completely flips. That euphoria from the bull run, it gets replaced by a climate of fear and just deep, deep pessimism. All the risk takers become risk-averse, and they start scrambling for the safest possible places to park their money. So, okay, we've got these two big opposing forces. But here's the thing, they aren't random, not at all. Let's zoom out for a second and look at the bigger picture, the great market cycle itself. At the end of the day, these market cycles aren't just about spreadsheets and economic models. They are driven by one of the most powerful and predictable forces on Earth, human psychology. That constant, rhythmic swing between collective greed and collective fear is what powers the entire machine. And believe it or not, we can actually measure this stuff. There are tools like the Fear and Greed Index that literally track the market's emotional state. They create this kind of emotional barometer, ranging from extreme fear all the way to extreme greed. It gives us this fascinating, real-time snapshot of the market's collective psyche. So this whole journey, it typically unfolds in 4 clear stages. It starts with accumulation down at the bottom, right? That's when the smart, savvy investors are quietly buying while everyone else is still terrified. Then comes the markup. That's the big bull run that gets everyone excited. At the top, we hit distribution, where those early investors start selling to the euphoric masses. And, well, that leads us right into the mark-down phase, the bear market. And then the whole cycle just begins all over again. And hey, if you want to see this exact same cycle but on steroids, you just have to look at newer, more speculative markets like crypto. All the same psychological forces are at play, but the roller coaster moves so much faster and the peaks and valleys are just way more extreme. I mean, just look at a chart of Bitcoin's history. You can see these cycles with perfect clarity. The bull runs are absolutely explosive, and the bear markets that follow are just brutal. It's the same 4-stage cycle we just talked about, just playing out on hyperspeed, driven by these massive swings in money and the stories people are telling themselves. Okay, so now we get the what and the why, but the big question is, what do you actually do about it? Let's get practical and open up your investor playbook to see how you can adapt your strategy for whatever season the market is in. Right, so your strategy really needs to change with the season. In a bull market, your playbook is all about offense. You're focusing on growth opportunities, maybe being a bit more aggressive. But in a bear market, you switch completely to defense.
Suddenly, the priorities are managing risk, building up your cash reserves, and maybe hunting for some amazing long-term bargains on high-quality assets that panicked investors have thrown away.
But here's the thing. Across all the seasons, the ultimate goal stays the same: long-term growth. And this is where discipline becomes your superpower. Two core principles have proven their worth time and time again: diversification, not putting all your eggs in one basket, and simply staying invested through all the ups and downs. Look, trying to perfectly time the market is a fool's errand. It's time in the market that truly builds wealth. So, after all that, what's the one thing you should walk away with? What is the single most important lesson here? Let's get to our final takeaway. It's all about embracing the cycle. And this quote just says it all. The goal isn't to perfectly predict when the next storm is coming. Nobody can do that consistently. The real skill is in preparation. It's about building a solid, robust strategy that can weather any storm that comes your way. So the question I want to leave you with is this: are you still trying to predict the rain, or are you busy building your ark?